Jeremy Schwartz, welcome to the chatter.
Jamie, thanks for having me.
Jeremy, we were lucky enough to meet each other recently at actually the London Stock Exchange conference in Georgia, which was great, the Wealth Forum. And you spoke so eloquently about markets, and we were talking about the outlook for 2023. So I thought you were a perfect person to have on the show. So thank you very much for joining. I should say that your role at WisdomTree is you are global CIO. So you're in a perfect position to perhaps help us navigate the markets we've got right now. So let's just jump straight in. I wanted to start by referencing what Christine Lagarde said last week at the ECB press conference. She said, if there's anyone out there who are expecting the ECB to pivot, they are wrong. Now, this is a US show, so I want to bring it back to the US and talk about where you think the Fed is right now regarding where you think rate hikes are going in 2023. And why don't we start there before we move on?
It's fitting as we wind up the year. We just had another inflation report. We just had another Fed meeting, and it's really been the year of the Fed in so many different ways. I mean, you could say a lot of the market volatility came from just really an adjustment in discount rates. The Fed aggressively hiked rates, and that you could say the market fall is just a factor of that. I would say as you're in this December period and the Fed is talking tough, we're going to keep rates high forever. You know, think back to where they were a year ago. And, the most hawkish of the FOMC people thought we'd get to slightly above 1%. You had 17 of the people basically think you're going to not get to 1%. So one of the things we're saying is you can't really trust anything they say. And, they were so far off on the way up and not thinking they were going to get to this over 4%. It's hard to take it at face value that they're going to keep it at 5 forever also. We do not think they will. We actually have a view that inflation is way coming down. And if they looked at real-time data, they would see it coming down even further than their goal. They say we got to keep it elevated to get back to our 2% goal. If they used real housing data, we actually see price declines, actually, not the 7% cumulative increase. And so, there's a big picture worldview that they don't have to do as much. But the longer that they stay with, in our view, looking at misguided data, the more challenging it becomes for the markets.
So I noticed the book you have in the background. I hope you don't mind bringing it up. I know it's your mentor's book, which mentors you, and perhaps you could talk about your
Yeah.
relationship. Um, I read in a recent interview he's relatively optimistic for equities for 2023. What's your stance on equities?
Yeah, so this you see Stocks for Long Run, the 6th edition on my bookshelf. I'm now the co-author with the professor on that. So I've been working with him for 21 years. My first project with him was the 3rd edition of the book, which came out in 2002. And so there's a lot of new material in the book, and there's a whole section on the pandemic. And inflation, this key issue of the money supply driving inflation is one of the big focus points. And that's one of the things that we say inflation is coming down. We actually have a contraction in the money supply now when you want it growing 5% a year. So there's a lot of great new material, a lot of material on factors, value investing. So a lot of it does come down to the Fed. And so I think the worse the Fed keeps rates, the more they're out of bounds with reality. In our views, that reality inflation is coming down. So the further they keep going with that stale narrative, the more challenges. We do think they will pivot and pivot quickly. And so that's partly his more optimistic view. You usually don't get people expecting down years. In stocks for the long run, 75% of the time the market's up. And so it's good to be optimistic. But you do actually coming in the year with Wall Street consensus being negative on the year, that's one thing where maybe sentiment is pretty negative. It's going to be all about earnings for next year, and so there is a downbeat view. Most people I'd say is consensus. We're going to have a recession, declining employment. We're a little bit more optimistic that this year there was terrible productivity. Next year you could have a rebound in productivity, and that's good for the economy, where you could have positive real GDP, decline in number of workers. But that could help margins if people are sort of getting rid of the fat and getting rid of the less productive workers, people who are working from home and not doing as much. That might be a positive story on margin. So that is the fear for next year, is that earnings come in weak. Analysts are around 230 on the S&P 500. People are saying 200, which basically we had last year. that'll be the key question. This last year was about the Fed. Next year's going to be about earnings, and we're a little bit more positive than sort of consensus there.
You mentioned sentiment just there, Jeremy, and I'm interested to go a little deeper on that because the famous thing that people say one thing and do another, and I think I saw there's so many different sentiment indicators out there right now that are so bearish. How big a factor is that? Do you think people are just presenting as bearish and actually have yet to really make any major shifts in terms of asset allocations, and they're still relatively there within equities and cash isn't too big? How do you feel people are positioned?
There is some data saying people are not short enough, that short interest exposure is at low levels, so even though they talk negative, that they're not positioned that way. You did see flows out of traditional active funds towards passive funds this year. That was a continued trend in bond land and equity worlds. I do think there's good question on where are people actually positioned, and there's even a question of, like, it's the Fed just talking tough to keep financial conditions tight. Is that maybe one of the whole keys of what they're doing, is that they might know that the inflation's coming down, but they're trying to keep the conditions tight to keep the policy more effective. So I do think a lot of it is rhetoric, but I still think next year, when you think about where are the valuations around the world, you could see it reflected in valuations for many stocks, that particularly international stocks, which are half the multiples of U.S. I think people are underweight, European stocks, underweight emerging market stocks, based on where valuations are. So reflected in valuations, I think the U.S. tech is still the quote unquote crowded trade to an extent. Value is sort of a less crowded trade, and international is a less crowded trade.
Let's look forward to 2023, and in particular about what could be the real big factors that could change the direction of where markets are right now. I'm thinking China, I'm thinking oil, the dollar itself. What big themes are you looking at as we go into 2023?
Well, there's certainly China and oil are very interrelated, and there's, for the whole sentiment on emerging markets, will they really follow through with the COVID, going away from COVID zero and reopening? That's obviously the big headlines of the day, and that could be, one of the pressures that were for lower demand for oil is China's one of the biggest consumers, and as they open, that could be very positive. You could say that perhaps offsets some of the downward inflation pressures. Commodity prices have come way down, and we say that is one of the things that are helping inflation. But the whole supply chain issues that cause from shutdowns, on balance, we think them opening is positive for that. So yes, China is one of the key global economic risks, but also potentials that could be better next year than this year. I do think it's going to stem back to, is the Fed over tightening? It's going to keep coming back to that question. And then how deep is the recession? How much does employment really come down? And is our view on productivity, does that overcome the decline in the workforce? Those are going to, for the U.S. markets, that's going to be the most important issue. Is how quickly the pivot comes, and does productivity overcome the loss in workers? Most
of the activity has obviously been at the short end of the curve when it comes to yields for obvious reasons. But can you talk a little bit about real estate?
Yeah.
I mean, for people in my situation, someone who's actually looking to buy a home at some stage soon, how do you feel real estate is going to perform next year?
Well, I think you're going to get a good opportunity here in the next 6 months. I think certainly real estate is the most interest rate sensitive economy, and doubling of mortgage rates is obviously going to put pressure on home prices, right? I mean, there's no question it becomes more expensive. Just the amount that you could afford is just dramatically lower with these higher rates. As much as 30% lower is what, to try to keep a flat mortgage rate. Our team did some modeling on that. I think you had a 40% increase in Case-Shiller home prices is what you had from March 2020 through, basically early this year. We'd expect a 10 to 15% pullback in aggregate. I mean, you wouldn't be surprised with the higher rates to see that come back. But I also, it's not our view that rates are going to stay elevated forever. I mean, our view is that rates are going to come back down. And in stocks for the long run, as you point out earlier on the shelf, we have a whole chapter on the long-term case for rates trending lower, real rates trending lower, slower economic growth, lower population growth, all those things lead to lower real rates, so we don't view that these longer term rates will stay elevated for a long time. Even in the short run, the market doesn't believe the Fed. I mean, the 2 years below the Fed funds rate, which tells you the market does not believe what the Fed's saying. So I do think rates will come back down. So if you get softness, and again, we think 10 to 15% weakness generally from the peak home prices, I'd take that chance, or maybe you have to lock in a high rate, but you'll be able to refinance at a lower rate within a few years, in my view. Right. So I think you should get those bids ready.
Final question then, Jeremy. This is the last episode of the year. We're keen to ask you, what's your kind of favorite trade for 2023?
I mean, it's boring, but I'm going to stick with what's worked this year. You had a 15-year period where growth dominated, the FANGs dominated. This was the year of high dividend stocks. So we have an ETF, DHS, high dividends. It was basically up close to double digits, at least through November. It was up over double digits, and obviously pulled back a little bit in December. But it rebalanced recently. It's at 10 times earnings, a little bit over 10 times earnings, which is a 10% earnings yield. The TIPS yields are just above 1%. So they have this 9% equity premium. I mentioned I think value is still going to be in favor next year. It's going to be still a choppy market for a little bit, and high dividends proved very defensive. I still think at almost half the multiple of the S&P 500, I think that's where you need to be for next year. So I'd stick with the old, tried and true, high dividend stock, less of the growthy FANG names.
There you go. You heard it here. High dividend stocks. Look at the value plays. Jeremy, as it's always a pleasure to chat to you. We caught up at the Wealth Forum, and it was great to have you on the show today. And thank you very much for your time.
Thanks, Jamie.